Welcome to Lighthouse Outlook, the podcast where we talk less about the markets and more about what matters to the people navigating them. From family offices to founders, we go beyond the numbers to unpack risk, legacy, and the human side of capital. Hosted by the team at McNichol and Associates Asset Management.
So, July 30th, go over this pretty quickly. A disclaimer just for our Canadian investors, not giving any securities advice. Contact one of our portfolio managers, someone on our website, if you have any actual securities questions. And then same with the US disclaimer for our US-based investors, just a disclaimer from the SEC. I'll be pretty quick here this week with the technical charts, leave most of my bulk of the speaking time at the end. 4-box reversal this week on the chart. Obviously, the conflict in the Middle East is driving the market sentiment. The semiconductor sell-off really is continuing, and a lot of investors are seemingly worried about the overspending and the sustainability of that trade. So have to see what happens there. Support 1 and 2 boxes lower. It's really been trading within this 5 to 6 box range for about 2.5 months, 3 months now. So something to watch there. If it can break up to the upside, obviously would be very positive after this consolidation period, but to the downside, the opposite. Overbought, oversold, lowest since March 27th, and that's the third straight week it's been oversold. The Mag 7, except for Apple and semiconductors, continue to lag. And as I said, investors are de-risking their portfolios, in my opinion. And really, the strongest sectors over the last week continue to be defensive. So not the same market we were in just a couple weeks ago when everything AI was shooting the lights out. Speaking of tech, Nasdaq here, 8-box decrease, new sell signal. That's the third straight. It did break all its short-term support lines. So the next support is at March's lows, which is 20 boxes lower. You can see the tech sell-off there and a couple of the names that I highlighted: NVIDIA, Intel, AMD, Tesla. So those are just a few of the companies that are selling off between 10 and 25% over the last 5 days. So quite a drawdown, I would say. And then in terms of the Nasdaq this year, it's up about 8% year to date, but it was up about 20% in June. So quite the 1 month swing here. The overbought, oversold, 61% oversold. That's the third straight week oversold. Also the lowest since March 27th. And then, as I said, investors continuing to de-risk their portfolios, rotating out of these semiconductor and AI related stocks. Obviously looking at valuations, looking at the feasibility of this trade in the long term, looking at bond yields potentially, and the conflict in Iran. And it's obviously spooking certain investors. Looking here at the Dow now, at no box change over the last 3 weeks. It remains at an all-time high. You can see numerous support lines. The value rotation continues. Investors are seeking safety, even in tech. I read a nice article this week, I think it was in the Wall Street Journal, and it was just talking about the flow that Apple shares have had relative to semiconductor stocks in the last few weeks. Just seeing that rotation away from high risk areas of the market, and in some eyes, or in some investor eyes, Apple is one of those defensive names. So we don't agree, but can kind of understand their thought process a little there. Obviously, when you're looking at Apple's cash flows compared to some of these AI companies. Overbought, oversold, slightly oversold, first time since April 3rd. So even the Dow seeing some pressure on the demand side. And then this TSX 60, no box change week over week. The defense and value tilt with energy exposure leading to constant outperformance here. Feel like a broken record saying it versus the US tech heavy indices in recent weeks. Obviously, oil rebounding has led Canadian energy names higher. Overbought, oversold remains elevated despite overall and global market equity volatility and uncertainty, sitting this week at about 44%. So continue to watch that, continue to like that. Looking here at the VIX, flat week over week, it has a new buy signal. That's the second straight. The uptrend continues to look like it's forming here. A couple weeks ago, I had mentioned it's been running flat. A month or two ago, it was in this downtrend for the previous month and a half. Now it looks like we're breaking to the upside. We're in a positive trend. Potentially see this VIX spike up in the coming weeks. And then looking at here, this is a bullish percentage charts. No real changes this week. NYSE moved up 2%, but nothing for us to go into depth about. And then the percent positive trends. These two charts delayed compared to the actual market. So it's no surprise the Nasdaq is seeing a dip here, dropping about 6%. Obviously, a lot of tech weakness, a lot of AI weakness, and that's spilling over into these Nasdaq technical indicators that we look at every week. And then the Toronto Stock Exchange, not a whole lot of movement here, so we'll skip this. Kind of, we'll say, neutral in terms of where all the technical indicators are for Canadian equities. And then looking here at the asset class rankings, some changes. Tech falls another position, now sitting at 170 buy signals. About a month and a half ago, it was sitting at 240 buy signals, so quite the large swing in just a couple of weeks. And the names, obviously, that are pushing to the top of the list in terms of sectors: healthcare, financials, utilities, and then industrials, which we've talked about in depth in this call in the past. But more of those defensive value tilted names. Obviously, that's not 100% true with industrials, but nonetheless, a trend that we continue to see. And then you can see the strength in commodities recently: agriculture, industrial metals, and energy. Continue to see some strength. A lot of buy signals increases in the past few weeks. Really only weakness that we're seeing is the precious metal space that we're continuing to watch very closely. Sector spotlight. This is just talking about NVIDIA. This is the cost of its 5-year CDS. The cost of insuring against, obviously, NVIDIA defaulting has doubled since May. Obviously, it's not a bankruptcy signal, as the implied probability of default is still kind of priced at 6.5%. It hasn't really moved up, but it is a warning that the credit markets are growing uneasy about leverage, and then the circular AI financing that we've talked about, and the durability of this CapEx boom. So something really interesting to watch that I found interesting. Obviously here, AI boom leading to massive selling by insiders. It's not just, I think, isolated in NVIDIA and CoreWeave, which are mentioned here. I think it's going to relate to a number of other companies. If you constantly are looking at insider selling and insider buying, I have a feeling a lot of these tech companies that have seen their stock prices surge in the last, let's say, 6 to 18 months. A lot of selling pressure there, and I think it'll also impact the likes of SpaceX, which obviously has a long lockup period there. Despite this pullback that we've seen, I'll say, in the tech area, you can see here, this is the Magnificent Seven. Right now, it actually looks very cheap relative to historical averages. You can see, dating back all the way to 2018, the Magnificent Seven forward PE ratio, and then the Magnificent Seven forward PE relative to the S&P 500. You can see that substantial pullback that we've seen since late 2025 in the PE ratio. Obviously, there's been an expansion of earnings for a lot of these companies, which has driven that. But we've also seen the stock prices of a number of these firms pull back pretty substantially. Meta, Alphabet, Microsoft. So we'll have to continue to see if that continues to occur. NVIDIA is also the cheapest it's been since 2015. So something of note. Wrote about that in this week's the Weekly Beacon. So just something that we haven't seen in a very long time. So obviously a lot of weakness in tech. So what market looks strong right now? The United Kingdom, obviously very, very low exposure to tech or publicly listed tech. It's up 9% year to date. You can see a nice surge that we've seen in the past month. It almost scores at a perfect 6 out of 6. Defensive names and banks continue to lead the way for the British stock market. The FTSE 100 is also at an all-time high. I think it reached that earlier this week. So looking for some other exposure, perhaps some other developed markets, including England. Looking here at crude oil price target, still pointing lower at 66, but Nice line of support there. We've seen a pop up earlier this week up into the high 80s, and I think yesterday it settled. The price of oil per barrel, I think, settled in the 84 range. Obviously, very volatile. We've been talking about this for weeks. I think there's a higher floor now just because of uncertainty. There's just constant discussions about further strikes, no peace deals. I think it's going to be very hard in the short and to midterm to actually iron a peace deal out. So I think you might as well stay invested in some of these quality energy names to get that uncertainty premium in the oil market. And then yesterday, Fed holds interest rates. Not surprising, but 3 members voted to hike. It was only expected that 2 members were supposed to vote to hike. And then you look out to September's meeting, which is the next meeting, September 16th. And right now there's about a 57.5% probability, according to the CME group, that the Fed will hike. That has increased pretty substantially. You can see about 1 month ago, that number was only about 48%, a 9% change in a matter of a month. So we'll have to see if that continues to drift higher, especially if inflation remains a worry for more and more investors. And then beyond that, another thing that we obviously have been looking at is the industrials sector. We own this ETF in our relative strength program. That's up 13% year to date. Price target sits at about 119, which is very bullish from where it's sitting at. It is a little expensive. The global industrial sector has gotten a little more expensive this year, about 27 times trailing 12-month earnings. But we still like the setup relative to other sectors, relative to tech. Obviously, there is some cyclicality tied to the industrial sector, but I think owning some quality names within the industrial sector really will have some upside. Obviously, not broadly holding everything. In our separately managed accounts, we own select industrial companies, but still looking at opportunities within that space rather than the actual tech sector and the directly related AI sector. And then last one, this is kind of the trend that I've been running on. This is an image created by Grok, actually, of the tech meltdown. I kind of put in a couple prompts, had no idea that there's been about $1.6 trillion in AI and SpaceX that have been wiped out in terms of value. But it put on all the big names. It, interestingly enough, put on SpaceX, despite obviously Grok AI on the X.com being owned by Elon, so there's no bias there. But I think that's it for me. So I'll pass it over to Joe or Dave.
Yep. Okay. Let's see. Finally got the update there. So just an update on the hedge fund. Little reporting came in from BSP. Looks to be pretty good. The main hedge fund, the multi-strat fund, up 7.3%, and volatility really low on this thing. And this is sort of the benefit of having a diversified approach to everything. So you can see the 3 and 5 year standard deviations below 3%. Like, that's incredible, in terms of hedge fund volatility. So here again, not all hedge funds are bad, and certainly when you combine several strategies together, it really can pay off. The STA strategy is trailing a little bit. That one tends to perk up a little bit later in the cycle, so you might see the July and August numbers continuing the positive trend there. And really good correlation again with stocks. The correlation can be summarized as there isn't any. In fact, it's negative. So that's positive in some ways. It's certainly a positive if you get further problems in the semiconductor space kind of spreading to the rest of the market, as Ken talked about. Quick update from Contrarian, our distressed credit specialists in the emerging markets. So up another 53 basis points for the month, and now walking around at 10% year to date net of fees. So that's positive. charts of the week really was centered on, I think, mainly this Goldman Sachs high beta momentum index. He spent a lot of time talking about that. Looks like you've got a situation here. So this is the S&P 500, and I think Ken, talked a lot about this already. But you can see it's now being more prominently pulled down by some of the more cap heavy companies in the index. By comparison, this is the major pivot point for the cap weighted version of the S&P 500. And so, there is some downside risk there to be had. I guess the good news is that major big picture pivot zone looks pretty robust, right around 7,000. But if you get further damage done, you could see an environment where you test 7,000. The S&P 500 has gone pretty much nowhere for the last 60 days, as we know, and the issue there is that a large chunk of the market has been doing okay from a percentage of stocks over their 200-day moving average perspective. But that's sort of one kind of technical indicator that's based on stock price movement and not necessarily market cap. And so that's why you've got sort of these indicators pointing to different directions. And once again, I think Ken talked a little bit about that. Just looking at the equally weighted version of the S&P 500, it did kind of perk up, broke through that band of overhead resistance fairly easily. But unfortunately, and this is the rub, the follow through hasn't been as good, and so that's sort of a problem. It's viewed by technicians as more of a flash in the pan type of pop versus a sustainable rally. So potentially, again, more downside risk. This is the main sort of chart here with the semiconductors. After hitting some of these really, really high levels, like crazy high levels, a lot of these are kind of selling off. And we talked about Micron and a few of the other names, on and off again. But the index has actually pulled back about 30% from its June high. So that's a lot in a fairly short period of time, I think. But, if there's any sort of consolation there, is you are coming to a point of support, not that much further down. So, stay tuned. This and the energy trade are sort of all, everyone's talking about in terms of AI capex and predominantly with Alphabet and Meta, but a few other companies as well. Again, Sun, Micron, and others. This is a new index. Well, not a new index. It's a new index that Andrew is talking about. It's the Goldman Sachs High Beta Momentum Index, and it basically operates on a monthly window, and you can see that one line there on the far right, like it's massive. And what this indicates is that the demolition in the semis has really kind of taken the wind out of the sails of many of the more high beta parts of the market. And so this is actually the worst reading that this particular index has had since the late 90s. And again, I'm not laughing to make light of a bad situation, but here again, and we talk about this often, is what's your downside risk protection. So I'll kind of leave it with that. Oil, in the write-up, again, he's got his charts here with the key spots for oil and the support zones. His view on oil is like, in the short term, it's just way too hard to call because it's taking a lot of its cues from obviously the situation in Iran. And so I don't think he necessarily feels one way or the other about oil, and particularly in the short term, he just flat out says it's a pretty tough trade to get right. So that's it for me. So Sean or Chris, maybe if you guys are on, any things you're seeing?
Go ahead, Chris, if you want.
Sorry, got my audio going here. Yeah, we're really choppy patch here in the rates market, and it got worse yesterday with the press, Kevin Warsh's CHR second press conference, and the he's been quite vocal about he's not giving forward guidance. The Fed's going to take their cues from the market as opposed to somewhat leading the market, as he felt the Fed did in the past. And the press conference got a bit testy, and a couple of reporters really challenged him on, well, why aren't you raising rates now? And his answers, were really sort of off base, vague, and almost non-comprehensible. And the long end just sold off heavily. Feeling is that he's not either not grasping inflation or he's not going to be fighting inflation. Whereas before, he came out really strongly that the Fed's mandate 2% inflation. Now I think people, are not buying that. They're saying, this guy, we don't know what to make of this guy. But I think stocks, when the long bond sold off, I think it was about $1.50 yesterday. I think that, stocks were down 1,000 points. Like it just was a horror show of a press conference. And, for somebody who doesn't want to communicate, when he does communicate it, he communicates really badly. And I see no improvement this morning. The long end is down another buck. So we're pushing up, long yields are at 520 in the US. The 10-year is at 4.665. So yields are pressing up into the range where you'd almost expect to see Scott Bessent come out and say, we've got the situation under control, and it's sort of ironic that Trump appoints a guy who, I think he believes was going to carry out his objective of lowering rates, and rates have smashed up, smashed him right in the face and risen really strongly. Canadian dollar, just wanted to touch on that. Canadian dollar did rally actually on that news. So it was down, not a huge amount actually. It's been a pretty flat range. But Canadian dollar is up slightly on the day-to-day news. And I guess I'll pass it back to, Ken's moderating, so I'll pass it back to you, Ken.
Awesome. Thanks, Chris. Sean, do you want to go ahead? I think Dave might be on mute right now.
Okay. Yeah, so this is the macro overview for... Can you hear me okay?
Yeah.
So this is the macro overview. What are we seeing? Asset classes, fairly mute. We're seeing a little bit of just very short-term weakness, I guess, on the back of Warsh's performance yesterday in the US dollar. We're seeing, gold has come off just a touch in the past week. Bitcoin and Ether, I think, are going to fail hard here out of this very short-term positive move with news that the Clarity Act is almost certainly going to be pushed to the fall. Oil is bouncing around like crazy. Other markets, we're getting into the August doldrums, but there's a lot going on under the surface. Economics, it's still kind of like slow and steady with GDP growth expected at 1.5%, which is below inflation, which is coming in, lower than people were expecting, but still, that's more than twice where growth is. We've got a hawkish bias still in Fed policy. Warsh has got a lot of pressure to cut rates from Trump, but in the short term, it's hard to get around oil being, at these elevated levels with really what I can say is no one's in sight for the Iran war. There's just no easy way out for the United States at this point. Israel still doesn't have what it wants, and Trump has been reluctantly re-engaged in this battle of egos. Are we in a recession? Certainly not now, but, just keep your eyes on employment. That is critical. The US dollar, as we've seen, came off a little bit yesterday, day before, but it's in this kind of box range around 100. The yen continues with its weakness. as a country that imports just about everything, which it then turns into fantastic products and energy, they are really susceptible to rising commodity prices. It looks like they have more rate hikes. We're seeing interest rates there climb. This is continued unwind of the yen carry trade. This is just very slow motion done in the shadows, but we will feel the reverberations from many of these very large, very levered trades getting closed over the next while. Gold, the significant downtrend in gold has moderated recently. You can see the yellow box on this chart. I see it, 39.50 to 41.50. I'll be, solidly buying at the 3,300 level. We've just had a ton of red on the heat map over the last, few months since March. And, seeing a little bit of sideways action here. We might be getting ready for another rally in gold as being an asset that, the Fed can't manipulate and is recognized globally. Silver is following gold almost to the T, kind of moving sideways out of that downtrend marked by the blue line. Oil, we had a nice pause there with oil prices coming back to where they'll likely be in the longer term, 50 to 60. But this escalation in the war is, putting Carg Island right into the crosshairs. And if that gets taken out, I think we will see a dramatic shift in oil. I'm not sure where the SPR is right now, but it continues to be drained. Rates and credit, as Chris well covered, in the short end, not much going on. The longer end is starting to see some bond vigilantes show up with rates moving higher. Now, the S&P, notably since over the last 2 weeks, we moved from a bull regime identified by the market model that I created using a Markov process. It moved to sideways, and yesterday it moved into a bear signal. I'm not saying that this is exactly a market top, but certainly between the Markov model and the heat map turning, mostly red, as you can see on the far right of the blue, yellow, and green bars, that's indicating a lower Sharpe ratio, a Sharpe effectively of around, 0 to a negative number over the near horizon. I would recommend, if you have interest, buying a put or looking at some of McNichol's short products here. Fear is back into the market as indicated by the CNN sentiment index. We never really got into like a bullish greed market. We're back into fear. And I think with what you see in some of the high flyers like SanDisk, Micron Technologies, we are at risk of seeing what drove this market higher over the last 3 years, leading it lower. The equity regime has shifted to bear. We're 2 days into it. The 60-day return is now like a minus 1.7%. The probability that we stay in a bear market is relatively high for the next 5 days at 65%. But based on a long history, the expected time in this state is only about 10 days. That's the history over which we built the model. Very long daily data. I like this model. We're not really trying to pick tops, but at transition points, we have to pay attention. Crypto is just continuing to be bad. The one ray of hope was that the Clarity Act would be passed. The Senate can pass it with its Republican majority, but it needs 7 Democratic votes to avoid filibuster, which the Democrats say that they will engage in. Nobody wants that, so it's likely just going to be pushed until the fall. And then likely, this could all happen again as midterms come into harder play. So I'm just avoid Bitcoin for now unless the Clarity Act gets done. Just nothing good to say about this entire sector at the moment, unfortunately. It is solidly in a bear market. We've seen, by the heat map, it had some of the recent strength based on the hope of the Clarity Act getting passed, but I expect that that could fade pretty hard. And then the cartoon for the equity markets today is it looks like this goes on forever. And little do they know, all good things come to an end. I would love to see this bull market continue, but when we do look at things like the SOX and what the hyperscalers and the companies selling the picks and the shovels to the AI trader doing, it sure looks like reminiscences of the tech crash. That's it for me.
Thanks, Sean. I guess Dave's having some tech issues, so I guess we'll just wrap it up pretty early today.
Yeah, good stuff, guys. I'm just on listen mode.
Okay, well,
so
I guess if anyone
good meeting.
else has anything to say, we'll wrap it up today and let you guys get on with your days. Have a great week, guys.
You too. See ya.
Thanks for listening to Lighthouse Outlook. If this conversation sparked a new perspective, share it with someone who thinks differently. Subscribe for fresh episodes every 2 weeks and visit mcnichollasset.com to learn more.